Hello everyone, my name is Eng Kang, and today I'm going to present about the financial analysis report of the IOI Group. The IOI Group is commonly referred as the IOI, and it was founded on 1969, and as of right now, it is a prominent multinational conglomerate that specializes in plantation and palm oil productions. The visions and missions of IOI is that they aims to be a prominent and sustainable business with a global reach as they strive for responsible and sustainable commercial success by considering all the interests of stakeholders and caring for the community or the environment and implementing the best practices to ensure global competitiveness. Next, let's move on to the ratio analysis of IOI. We'll be covering five main areas of ratio like probability, liquidity, efficiency, long-term solvency, and shareholders' investment ratio. First, probability ratio showcases the ability of the company to earn profits from its sales or operations. As you can see from the graph and the table provided, gross profit margin shows how much the business is earning by comparing the gross profit revenue. The gross profit margin has increased by 4.81% from 18.71% to 23.6% due to a major increase in revenue. Next, net profit margin of the IOI assess the ability of the company to generate profit. The net profit of margin of IOI has a slight decrease of 1.24% due to the lower contribution of segments and loss in borrowings, even though the revenue of the IOI has increased. Besides that, the ROE, which is the return on the equity, has increased by 2.21% as the group shareholders' equity has increased. Other than that, the asset turnover ratio measures the effectiveness of average total assets in generating revenue. It is observed that the asset turnover ratio has improved to 0.85 in the fiscal year of 2022 compared to the previous year where it stood on 0.65. This indicates that the IOI group effectively utilized its asset to generate sales, reflecting a favorable asset turnover ratio for the company. Next, liquidity ratio. The liquidity ratio of LI has shown improvement as both of the current and quick ratio has increased. This indicates that the company is able to pay off its obligations and ensure a favorable liquidity position. Next, as for the efficiency ratios, the collection period of the LI has decreased from 35 days to 27 days. This decrease in the collection period suggests that the company is now collecting payments at a faster rate compared to the previous year. On the other hand, the payment period of trade payables has remained unchanged at 12 days comparing to the previous year. This indicates that the company has an efficient collection mechanism in place, and it also suggests that a significant proportion of its customers is making prompt payments to settle their debts. This efficient collection process and timely payments from customer is a major factor that the IOI group is in a good financial position. And besides that, the company has improved its ability to sell inventory as the inventory turnover in days has decreased from 37.27 days to 33.95 days, and the inventory turnover has increased from 9.79 to 10.75. This shows that the company has improved its ability to sell its inventory. Next up, interest cover ratio. Interest cover ratio assesses the ability of the company to honor its debts and interest charges. The interest cover ratio of the LI has improved from 10.6 to 15.66. This improvement in the interest cover ratio will be advantageous for the company as it increased the likelihood of creditors and other lenders offering loans as the company demonstrates the ability to cover interest charges. Other than that, the leverage ratio is a measure of a company's ability to meet its financial obligations. The decreasing leverage ratio of the LI groups indicates that the company is in a favorable financial position as it drops from 0.42 to 0.41, which is a slight decrease. A lower leverage ratio suggests that the company is financially responsible and has a stable revenue stream, making it potentially safer investment during the periods of economic instability. And finally, at the last of the ratios, shareholders investment ratios. The dividend yield of IOI has increased due to the rise of market price, and this improvement indicates that the company's stock price has been falling or dividend payments have been increasing at a higher rate than the company earnings. Other than that, the EPS, which is earnings per share of IOI, has increased from 22.6 cent to 27.74 cent due to the higher net profit. However, the price earning ratios has declined from 16.89 to 13.84. This decline suggests that the investor were willing to pay less for each units of earnings compared to the previous year. Next, the comparison between IOI and KLK. For IOI, we can see for IOI in the net profit margin, we can see that a notable decline in 2019 due to the reason that in 2018 the company received a substantial amount of profit from discontinued operations. Therefore, it is important to recognize that 2018 was an outlier of for IOI, perhaps, whereas the KLK has been improving slow and steady throughout the years until 2021, as this goes the same to IOI. They both experienced an improvement in their net profit margins as they both reach 12%, as this can be contribute to the rise in revenue for both companies. Next, we check out the liquidity of both companies at 2019. Both IOI and KLK experienced an increase in their current ratios. IOI's current ratios rose to 3.92, indicating a significant improvement in liquidity, whereas KLK current ratio also increased to 2.83, although it remained lower than IOI's ratio. In 2020, there was a decline in current ratios for IOI, as IOI's current ratios decreased to 2.66, while KLK's current ratio slightly increased to 2.97. Despite the decline for the LI, both companies maintain relatively favorable liquidity positions. In 2021, both IOI and KLK saw a significant drop in their current ratios. IOI's current ratio decreased to 1.06, indicating a decrease in liquidity, whereas KLK current ratio also declined to 1.54, suggesting a weaker liquidity position compared to previous year. This significant shift can be observed between 2020 and 2021 can be attributed to the substantial borrowings undertaken by the IOI group in 2021. And finally, in 2022, both companies experienced a recovery in their current ratios, as IOI's current ratios increased to 1.78, reflecting an improvement in liquidity, whereas KLK current ratio also increased to 2.04, indicating a stronger liquidity positions than IOI group compared to the previous year. Next, let's take a look for the both companies in their efficiency ratios. Both companies has a similar collection period, as we can see from the graph. It is just that in 2021, the correction period has a notable increase in the trade receivables correction period for the both companies. IOI's correction period rose to 35.85 days, indicating that it took longer to collect payments compared to the previous year, whereas KLK also experienced an increase in its correction period, reaching 36.02 days. This increase in trade receivable collection period could be attributed to the ongoing impact of the pandemic that challenges the customers in making timely payments. However, in 2022, the collection period has reduced back to the average days due to the recovery of the post-pandemic. Next, let's take a look at the long-term solvency ratio. For interest cover ratio, both companies has a similar ratio until 2021 as LI's interest ratio surged to 10.56, indicating a notable improvement in its ability to cover interest expenses. This implies that the IOI group has a greater capacity to take on additional credit as the creditors are more likely to extend loans to the companies with a strong track record of timely interest payments, as a higher interest cover ratio indicates that a smaller portion of the company operating profit was utilized to meet its interest obligations. One of the factors that might contribute to this increase may be the growth in gross profit as it rose from 1,675 million in 2022 no sorry is in 2020 to 2,289.7 million in 2021. This expansion in operating profits positively impacts the interest cover ratio as the higher operating profits leads to improved ability to cover interest expenses. On the other hand, KLK ratio increased even more substantially to 12.18, reflecting a significant enhancement in its interest coverage. As the gross profit of KLK Berhad has increased significantly as the increase affects the interest cover ratio in a positive way. The trend continues in 2022 with the RI interest cover ratio further increasing to 15.66, demonstrating a stronger ability to cover interest expenses, whereas KLK ratio decreased to 9.48, suggesting a slight decline in its interest coverage compared to the previous year. And finally, in 2020, and finally, let's check out the shareholders' investment ratio. In 2019, both companies experienced a significant increase in their price to earnings ratios. IOI's price to earning ratio surged to 44.4, while KLK price to earning ratios reached 43.1. This suggests that investor confidence in both companies' earnings prospect was high, and this indicates that the investor were willing to pay a higher price for KLK's earnings compared to IOI's earnings. This significant increase might be due to the expectation of investor that the future earnings will be higher than the current level, which would lead the stock price of as overvalued. And in 2020, the price to earning ratio for IOI rose further to 66.63, while the KLK price to earning ratio declined to 33.3. These fluctuations can be attributed to changes in investor sentiment and market expectations regarding each company's future earnings growth potentials. As the decrease in KLK might be a strategy to attract investor to invest for the purpose of bargain, as the decrease in price to earning ratio is like lowering the price tag for the investors. However, in 2021, both companies experienced a decline in their price to earning ratio as IOI's dropped to 16.89, while KLK drops to 11.8. This indicates that the investor were willing to pay a lower price for each unit's earnings, possibly due to revised growth expectation or changes in market conditions. In 2022, both companies continue to witness a decline in their price to earning ratios as IOIs fell to 13.84 and KLK decreased to 9.6. Lastly, the IOI has shown positive performance in the fiscal year of 2022 with improvement in profitability and investment ratios. The increase in profitability ratios indicates a higher profit for the year, while under the valuation of the stock suggests a potential opportunity for the investor to purchase them at a lower price before the market corrects itself. It is worth noting that the IOI has outperformed KLK in terms of profitability over the past few years. However, when it's come to liquidity and efficiency, IOI appears to be a bit weaker compared to KLK. Therefore, it is recommended that investor in investing LI group as this time as it demonstrate feasibility, growing dividends, and an opportunity to benefit from the mispricing of share price, which is likely to be corrected by the market, resulting in a satisfactory capital gains. Thank you.